Now that you've learned about the various forms of ownership a company can have, you will study the different types of businesses for which bookkeepers must be able to record transactions. The types of businesses you will study are service, merchandising, and manufacturing companies. A service company is a business that offers services to the public. A doctor, a lawyer, and an airline are all examples of service-type businesses. In a service business, there is usually one revenue account for each type of revenue earned, and various expense accounts that are used to record the costs of operating the business. The revenue is earned by doing work or offering a service to another person or company, not by selling products. A service business, therefore, does not have a purchases account, and no inventory is recorded on the balance sheet. A merchandising organization purchases various products from its vendors for resale to its customers. When goods are purchased for resale, they are recorded in an account called purchases. The purchases account then appears on the income statement as a type of expense. Now you will explore further how this purchases account is recorded, and examine some of the year-end adjustments that are required in a merchandising business. You may recall from Basic Bookkeeping Level 1 that in bookkeeping you use the accrual basis when preparing financial statements. This means that you record revenue when it is earned and match it to the expenses that are incurred. In a merchandising business, you earn revenue when you sell products to customers. When preparing the financial statements, you must match, as closely as possible, the costs of the products sold to the revenue you have recorded from selling them. In this sense, rather than expensing all purchases made during the year, you only write off the cost of the goods you actually sold during the year, and the rest of the purchases will remain in the inventory account on the balance sheet. The inventory is then ultimately expensed in the year in which the goods are sold to the customers. A merchandising business's income statement includes a section called the cost of goods sold. Here is an example of a calculation of the cost of goods sold for the month of February 2005 for Baxter's Used Cars. Baxter's is in the business of buying and selling used automobiles. On February 1st, they had $74,000 worth of used automobiles on their lot. Then, during the course of the month, they purchased cars worth $42,000 and recorded these in their purchases account. The total goods they had available for sale during the month was their beginning inventory plus their purchases, or a total of $116,000. At the end of every month, Mr. Baxter counts the cars on his lot and determines their value based on the price he paid for them. On the last day of February, he determined the value of the cars on his lot to be $82,000. With this final piece of information, you can calculate the cost of the cars actually sold during the month. If you take the total cost of the cars available for sale during the month of $116,000 and subtract from this the cost of the cars still in inventory at the end of the month of $82,000, you see that the cost of the cars sold must be the difference, or $34,000. As you already learned, when goods are purchased, they are recorded in a purchases account. Therefore, when Baxter's purchased the automobiles for resale during the month, they would have debited purchases for $42,000 and credited cash for the same amount. Then, as the cars were sold, they would debit cash for the amount of money received and credit sales for the same amount. In merchandising businesses, at the end of the year or period, there is a purchases account on the income statement that equals $42,000. But this is not necessarily the cost of all cars sold during the year or period. What you need to do is update the inventory accounts. On February 1st, the inventory account for Baxter's Used Cars had $74,000 worth of automobiles in it. This has not been adjusted for the purchases made during the month, or for the sales made during the month. The easiest way to adjust the account so that it includes the actual closing inventory figure is to close out the original inventory figure and set up the new closing amount. So, with merchandising businesses, there is an additional closing entry that must be made to update the accounts for the periodic inventory. A periodic inventory system simply means that the inventory account is updated periodically by counting and valuing the inventory on hand at a particular time. In Baxter's case, this is done at the end of every month. In order to adjust the inventory account to its actual month-end balance, you will use the income summary account. Since the inventory account originally had a debit balance of $74,000, you will reduce this account to zero by crediting it. The other side of this entry will be a debit to the income summary account for the same amount. In the task, you will practice recording bookkeeping entries for a merchandising business and calculate the cost of goods sold.